It's Chapter 1, The Reality.
Financial confidence comes from understanding that market fluctuations are a normal feature of investing, not a flaw. By recognizing the historical frequency of market corrections and downturns, investors can avoid panic and stay invested for the long term.
Hello, everyone, and welcome to ZAM Audiobook.
Thank you, Ellie. I'm really excited for today's discussion.
Yeah, me too. So I want to start by asking you to imagine, what if the very instinct that keeps you alive in the physical world is, the exact thing that destroys your wealth in the financial?
Wow. Yeah, that is a pretty intense way to look at it, but it is so true.
Right. So today, we're really diving into this whole illusion of safety. Our main objective for this deep dive is to build a framework for unshakable financial.
Absolutely. And I think we need to clarify right up front that this confidence, it does not come from having some sort of crystal ball to predict the future.
No, definitely not. And it certainly doesn't come from just hiding your capital under a mattress.
Right. It really comes from understanding the actual fundamental architecture of how the global economy works. Because, most people operate under this assumption that to be a successful investor, you have to dodge the crashes.
Yeah, like you have to perfectly time the economic booms and bail out before things get bad.
Exactly. And we really need to completely reframe that perspective today.
So let's look at the actual structure of the market. Because the financial market, it is not this static, predictable machine. It is a dynamic, living ecosystem.
Yeah, an ecosystem driven by millions of participants every single day.
Right. And in this ecosystem, volatility is not an error. I think that's the biggest takeaway. It is not a bug. It is the actual mechanism by which assets are priced.
That is such an important point. Let's talk about market corrections. Technically, a 10% drop from a recent high is classified as a correction.
And when people see their portfolio drop by 10%, the natural, neurological response is just pure panic.
Oh, of course. It feels like the sky is falling. But if you look at the statistics, like looking back over a century of global market data, these 10% corrections, they happen roughly once every single year.
Every single year.
Yeah. They are as structurally inevitable as the seasons changing. It is like knowing winter is coming. You don't panic, you just wear a coat.
I love that analogy. You just wear a coat. But why do these corrections actually happen? What are the mechanics there?
Well, markets are constantly digesting new information. Interest rate changes, geopolitical tension, supply chain disruptions.
Right, the news cycle is always churning.
Exactly. So a correction is simply the market rapidly adjusting asset prices to reflect those new risks. And the data shows that the average duration of these pullbacks is actually incredibly short.
How short are we talking?
On average, just 54 days. It is just a brief period of repricing.
54 days? But what about the bigger drops? Because those are the ones that really terrify people.
You mean bear markets?
Yeah, bear markets, a drop of 20%, right?
Right. And historically, those happen every 3 to 5 years. And retail investors, they tend to view bear markets as this catastrophic failure of the whole system.
Yeah, like capitalism is ending.
Exactly.
Yeah.
But institutional investors, the professionals, they view them as a necessary clearing mechanism. A bear market basically flushes out excessive leverage in the system.
Resets valuations.
Yeah, and it punishes inefficient companies. It's really a natural destruction process that paves the way for future growth.
And there's one piece of empirical evidence that I always find so comforting.
What's that?
Every single bear market in recorded history has eventually been followed by a sustained economic. Every single one.
Every single one. The upward trajectory of human innovation, population growth, all of that ensures the market inherently trends upward over the long term.
Right, despite those severe disruptions. But let me play devil's advocate a second.
Okay, go for it.
If we know a 20% drop is coming every few years, why shouldn't an investor just pull their capital out, hold it in cash, and then, deploy it only after the market has...
Market timing. That brings us to the mathematical impossibility of timing them.
Right, because it sounds so logical in theory, it does. But the premise assumes you can accurately predict two completely separate events. The exact moment to exit at the top, the exact moment to re-enter at the bottom, which nobody can do.
Nobody. Because the market's upward momentum, it doesn't happen in a smooth, straight line. The vast majority of compounding growth occurs in these sudden, highly compressed bursts.
So if you pull your money out because you're scared of volatility, you are stepping out of the cycle exactly when it's most critical.
Exactly. Quantitative analysts call this volatility clustering. Basically, large price movements, both up and down, they cluster together.
So the worst days in the market are almost always followed by the absolute best days.
Yes. When panicked retail investors trigger massive sell-offs, prices drop way below their fundamental value. And once that selling exhaustion is reached, smart capital floods back in.
Which causes violent upward surges.
Right. So if you were sitting in cash, waiting for the news to sound positive before you reinvest, you're mathematically going to miss those initials.
And the data on missing those days is just devastating.
It really is. Look at a 20-year investment horizon. There are thousands of trading days in 20 years. If you miss just the top 10 performing days out of thousands, your overall annualized return is cut entirely in half.
Wait, cut in half just from missing 10 days?
Yes, and if you miss the top 30 days, your returns basically approach zero.
That is unbelievable. Let's think about a practical example. Like, imagine a family saving for their children's university education.
Okay, yeah.
And they panic during a global crisis. They liquidate their portfolio to, quote unquote, protect their capital.
But by moving to cash, they haven't protected anything. They have permanently locked in a transient loss.
Right. And when the market violently reprices upward the following, their capital is just sitting idle.
They missed the structural recovery. The cost of trying to avoid temporary volatility is literally the permanent destruction of your long-term purchasing power.
Exactly. So the biggest danger isn't a crash, it's being completely out of the market.
Chapter 2. The silent wealth killer investment fees.
Small percentage fees can drastically erode long-term wealth by neutralizing the power of compound interest. Choosing low-cost index funds over actively managed mutuals is one of the most effective ways to protect it.
So if running from the market is a huge behavioral error, we really have to talk about an even more insidious danger, something that hides inside the market itself.
Oh, you were talking about investment, the silent wealth killers.
Exactly. Because the financial services industry, they are brilliant at masking the true cost of their product.
They really are. The standard narrative they sell is that capital markets are just dangerously complex.
Right. Like you couldn't possibly understand it on your own. Right. So they tell you that you must hire a highly compensated professional to navigate them. This is the whole premise of active management.
Paying a fund manager to analyze companies, time the market, and supposedly beat the general market average.
Yeah, and people just assume that paying a premium fee guarantees premium performance.
But the data tells the exact opposite story, doesn't it?
It really does. Over a 15 to 20-year period, roughly 96% of actively managed mutual funds completely failed to beat their benchmark index.
96%. So you are paying a premium price for a mathematical failure.
Exactly. It begs the question, why do thousands of highly educated analysts with supercomputers consistently underperform just a basic market average?
Well, a big part of it is the efficient market hypothesis, right?
Right. Information travels instantaneously now. Millions of algorithms are analyzing the same earnings reports at the exact same time.
So any price inefficiencies are just arbitraged away in millions?
Exactly. It is virtually impossible for a single human manager to consistently exploit those inefficiencies over decades.
But isn't the actual reason they underperform so badly the structural drag of their own operation? Like the cost?
Yes. The internal costs are massive. They pay exorbitant salaries, they have heavy transaction costs from constantly trading, and they have to hold cash to handle daily redemptions.
Which creates a cash drag in a rising market. And all of this is passed down to the investor in the form of an expense ratio.
Usually around 2% annually, which to the human brain sounds negligible.
Right. We think linearly. The manager takes 2%, I keep 98%. No big deal.
But investment returns are geometric, not linear. That 2% fee is not 2% of your profits.
It is 2% of your total assets under management, extracted every single year, whether the market goes up or down.
Exactly. Let's break down the math on this because it is terrifying. Let's say the market generates a gross return of 7% in a given year.
Okay, 7%. And let's factor in inflation. Say inflation is running at 3%.
So your real purchasing power return is 4%.
Right.
Now, if that fund manager takes a 2% fee, they are not taking 2% of your wealth. They're confiscating 50% of your real return for that entire year.
50%. That is wild. And over a 30-year timeline, the compound effect of that is catastrophic.
Because the money you pay in fees is money that is no longer compounding on your behalf.
Right. Think about a dedicated employee putting 10% of their paycheck into a retirement account. That fee acts like a slow leak in a tire.
A very slow, very expensive leak. Because of that lost compounding momentum, a 2% annual fee will consume nearly 2/3 of the total wealth your portfolio could have generated.
2/3. So you take 100% of the risk, you provide 100% of the capital, and the financial institution extracts over 60% of the final wealth.
It is highway robbery.
So what is the practical alternative for a regular person? If active managers are so expensive and rarely win, what do we do?
The solution is structural simplicity, the passive index fund.
Right. And an index fund simply buys and holds all the stocks in a particular market, right?
Exactly. It bypasses the entire active management apparatus. It doesn't employ analysts to predict the future. If the companies in the index grow, you capture that growth.
And because it operates mechanically, the internal costs approach zero.
We are talking expense ratios dropping from 2% down to as low as 0.03%.
Wow. So by eliminating the active manager, you eliminate the trading costs, the cash drag, and you keep the money in your pocket to compound over decades.
You guarantee that you capture the growth of human productivity rather than subsidizing the lifestyle of Wall Street executives.
Chapter 3. The Fiduciary Standard in Financial Advice.
Not all financial professionals are legally obligated to act in their client's best interest. Understanding the difference between a broker operating under a suitability standard and an independent fiduciary is crucial for securing objective advice. Okay, so if active fund managers aren't looking out for the investor's best interest, people listening are probably wondering, who they can actually trust for financial advice.
That is the million-dollar question, because people do need professional guidance, especially for complex things like estate taxes or business buyouts.
Right. The immediate assumption is you just walk into a major brokerage firm and ask an advisor for help.
But that brings up a shocking fact. Only a tiny fraction, roughly 1% of financial advisors are truly independent.
1%. That is a statistic the financial industry definitely tries to keep hidden.
Oh, they lobby heavily to obscure it. The title on a professional's business card, whether it says financial advisor or wealth manager, it is functionally meaningless.
So what actually matters?
What matters is the legal standard governing their operation. We really need to define the difference between a broker and a fiduciary.
Let's do it. What is the regulatory framework for a broker?
A broker operates under what is called the suitability standard.
Suitability, okay.
Which simply dictates that the financial product they recommend must be broadly appropriate for someone of your age and income bracket.
That sounds okay on the surface, but there is a massive loophole there, right?
A massive. The suitability standard allows for huge conflicts of interest. A broker is legally permitted to recommend a product that pays them a lucrative, hidden commission, even if an identical, cheaper product exists.
So they are essentially distributors for financial product manufacturers, like getting advice from a car salesperson instead of a doctor.
Exactly. If a brokerage firm creates a proprietary mutual fund with a 5% upfront sales load, the broker is incentivized to sell that specific fund to generate revenue for their firm. They serve two masters.
The client and the brokerage house. So what about a fiduciary?
A fiduciary operates under a much stricter legal mandate. They are legally required to place the client's financial interests above their own. Undivided loyalty.
Meaning they must eliminate or disclose any conflicts of interest.
Right. They have to recommend the absolute lowest cost, most efficient investment vehicle available, regardless of how they are compensated.
To really understand the mechanics of this, we should talk about the hidden revenue streams in the brokerage. Like, what are 12B1 fees?
Oh, 12B1 fees are recurring marketing and fees that are just inside the expense.
So the investor pays them without even realizing.
Exactly. Brokers also get revenue sharing, where a mutual fund company literally pays the brokerage firm for shelf space.
Like a grocery store charging a cereal brand to be at eye level.
Exactly. It guarantees their expensive funds are recommended to retail clients.
Let's use an illustrative example. Imagine a retiree to transition their portfolio from growth to safe, fixed income.
Okay, so a broker operating under the suitability standard might sell them a complex, high-fee variable.
Because it's technically suitable for income, but it pays the broker a massive upfront commission.
Right, but it locks up the client's capital with huge surrender charges and internal fees exceeding 3%.
Whereas a fiduciary, looking at that exact same retiree, would recommend what?
A fiduciary would recommend a simple ladder of low-cost government bonds and passive index funds. They charge a transparent, flat fee, receive zero kickbacks, and the client retains liquidity.
So how does a regular person navigate this? What actionable advice?
You have to force the professional to declare their legal status Ask them a question.
Like what?
First, are you legally registered as an investment advisor operating under the fiduciary standard?
Okay, that's straightforward.
Second, are you acting as a fiduciary 100% of the time, or are you dually registered as a broker? Because many of them switch hats depending on...
Sneaky. You want a pure fiduciary.
Yes. And finally, ask, do you receive any third-party compensation or revenue-sharing payments for recommended investment? If they can't give you a simple no in writing, you are talking to a salesperson.
Not an objective financial architect. That is such a critical distinction. Chapter 4. The 4 core principles of investing. Successful investing relies on 4 foundational rules: avoiding significant losses, seeking asymmetrical risk and reward, maximizing tax efficiency, and broad diversification. These principles help maximize upside while strictly limiting downside exposure.
Okay, so once a listener has minimized those fees and found trustworthy advice, they actually need a concrete investing book.
Yes, they need a framework. Institutional capital-like endowments and sovereign wealth funds, they don't rely on intuition. They operate on a rigid mathematical framework. Right. The core 4 rules used by the world's most successful investors. Let's break those down.
Yeah.
Rule number 1, don't lose. It sounds so obvious, right? Don't lose. But retail investors focus obsessively on maximum upside. They want the stock that will return 300%.
While the professionals focus obsessively on maximum drawdown, they look at the mathematical destruction of capital. Because the drag of a financial loss, let's say you invest $100,000 and the market drops.
So your capital is reduced to $50,000.
Right. Now, to recover back to your original $100,000, a 50% gain is...
No, a 50% gain on $50,000 only gets you to $75,000. You are still down.
Exactly. To recover from a 50% loss, you must generate a 100% return. The deeper the loss, the more exponential required returns.
An 80% loss requires a 400% gain just to break even. Capital preservation is the absolute prerequisite for wealth, which leads us perfectly into rule number 2, asymmetrical risk and reward. Right, because the prevailing myth is that high returns require taking catastrophic risks.
Yeah, symmetrical risk. Wagering your entire life savings for the chance to double it. Sophisticated investors don't do that. They asymmetric.
Meaning risking a little to make a lot. The downside is strictly capped, but the upside is exponential.
Think about how venture capital... A firm might invest in 20 early-stage tech companies. They know statistically that 15 of them will fail completely.
So the downside is limited to a 1x loss on those specific investments.
Right. But 2 of those companies might achieve a 50x return. That exponential upside massively overwhelms the capped downside of the...
And for a normal public market investor, how do they achieve that asymmetry?
Through valuation discipline. Buying high-quality assets when they are mispriced during a market. When you buy an index of great companies at a 30% discount during a recession, the downside is limited. The upside is profound. That makes... Now, rule number 3, because it's not about what you earn, it's about what you...
Exactly.
The single largest expense over an investor's lifetime is not market volatility or fee. It is the friction of taxing.
The tax code is literally designed to penalize short-term trading.
If you constantly buy and sell assets within a calendar year, you trigger short-term capital gains taxes, which are taxed at the highest ordinary income.
So a seemingly brilliant trade that makes a 30% profit might lose half its value to taxes immediately.
Yes. And actively managed funds generate massive tax drag through portfolio turnover. When the manager sells stocks at a profit inside the fund, the tax liability is passed on to you, even if you didn't sell yours.
Which is another reason passive index funds are structurally sounder. They have incredibly low turnover, deferring those capital gains indefinitely. Patience literally pays off. It really does. And that brings us to the final rule, diversification. Now, a lot of people think diversification just means buying 30 different tech stocks.
That is just the illusion of safety, because those companies are highly correlated. If the tech sector crashes, your entire portfolio collapses.
But I call that diversification. So how does a young family ensure they are diversifying safely without just buying random assets?
True diversification requires deploying capital across non-correlated asset classes, geographic regions, and currencies. It's based on modern portfolio.
So combining assets that behave differently under various economic conditions.
Exactly. You own domestic equities for economic expansion, emerging markets for demographic growth, and sovereign bonds as a deflationary shock absorber. By spreading it out, you eliminate single-point failure. Chapter 5, Preparing for Economic Storms and Asset Allocation.
Surviving financial crises requires extensive preparation. Implementing strategies like a multi-year income cushion and a risk-balanced portfolio ensure stability across all economic environments.
So principles are great in theory, but they have to be stress-tested against real inflation, recessions, global crises.
Absolutely. Your asset allocation has to be engineered to withstand macroeconomic shocks without forcing you to capitulate and sell everything.
And the foundation of that preparation is liquidity management, specifically Rule of 7.
Sure. The Rule of 7 dictates that an investor entering retirement should keep 7 years of their expected income need in highly stable, non-correlated asset, like short-term bonds.
Why exactly?
Because empirical data shows that even in the most severe historical market crashes, a broadly diversified equity index takes about 5 to 7 years to reach the bottom and fully recover.
So if you have a 7-year income buffer, you are never forced to sell your stocks at rock-bottom prices just to pay for your street.
Exactly. You just spend down the safe buffer while the equities recover. It completely eliminates what we call sequence of returns.
That is a massive psychological. But beyond the liquidity buffer, we have to address the structural allocation.
Right, because most investors just balance their portfolio by capital like 60% in stocks, 40% in bonds.
But stocks are mathematically much more volatile than. So in a 60-40 split, over 80% of your actual portfolio risk is driven by the stock market.
You aren't balanced at all. You are heavily skewed toward equity risk. To achieve true balance, we use risk parity, engineering a portfolio designed to survive the 4 economic seasons.
The 4 seasons, let's break those down. It's based on growth and inflation.
Yes. Growth rising, growth falling, inflation rising, and inflation falling. Every asset class is biased toward a specific environment.
Like equities thrive when growth is rising and inflation falling.
Right. And government bonds thrive when growth is falling. Commodities and gold thrive during rising inflation. Because no one can predict which season is next, you have to hold risk-weighted allocations to all of them.
Let's look at the specific allocation of an all-weather style portfolio designed for this. Roughly 30% in.
Okay, 30%.
40% in long-term treasury, 15% in intermediate treasury, 7.5% in gold, and 7.5% diversified.
That is a very structurally sound, low volatility model.
But I have to push back here. Holding 55% in bonds for a 25-year-old student or a young engineer in the accumulation phase, that seems overly conservative.
It does seem that way on paper.
Right, because equities mathematically deliver higher expected returns over a 4-year horizon. Why intentionally drag down your compounding with so many low-yielding bonds?
From a purely mathematical standpoint, you are right. A young investor should be heavily in equities to optimize for the highest return. But asset allocation is not an exercise in pure mathematics. It is an exercise in behavioral compliance.
Behavioral compliance, meaning what you can actually stomach.
Exactly. A 100% equity portfolio will regularly experience drawdowns of 40 or 50%, and the human nervous system is generally incapable of watching half its net worth evaporate without panicking.
So if that 25-year-old experiences a crash, panics, and liquidates at the bottom, their theoretical 40-year return drops.
Yes. The heavy bond allocation acts as a massive shock absorber. During a deflationary crash, central banks cut interest rates, which makes long-term bonds surge in value.
So the bond appreciation offsets the equity. The portfolio might only drop by 10%, while the broader market drops by 40%.
Exactly. For the average retail investor, a portfolio that delivers a 7% annualized return with low volatility is vastly superior to one that theoretically delivers 9%, but is so volatile you abandon it during the first crisis. Chapter 6. The Psychology of Wealth and Behavioral Pitfalls.
Human neurology is wired to treat financial losses as mortal threats, leading to poor decisions. Overcoming innate biases is essential for maintaining an investment strategy. That point about behavioral tolerance perfectly sets up the ultimate vulnerability, the investor's own brain.
Oh, absolutely. You can build a mathematically flawless portfolio, but it will collapse if you don't manage your psychology.
Let's discuss the neurobiology of investing. Our brains evolved in environments of physical scarcity and danger. The amygdala operates on a fight-or-flight mechanism.
Right, and functional MRI scans actually show that the human brain processes the loss of financial capital using the exact same neural pathways it uses to process a mortal physical threat.
A mortal threat, like being chased by a tiger.
Yes. When you watch your portfolio drop, your brain releases a flood of cortisol and adrenaline. The prefrontal cortex, the logical planning part of your is literally bypassed.
You are in a state of biological, and in financial markets, flight means selling everything at the absolute bottom to stop the.
And this biological wiring manifests in a series of predictable cognitive biases. The first one is confirmation bias.
Which is seeking out information that only proves what you already believe, right?
Exactly. If you are heavily invested in a specific sector, your brain unconsciously filters out data that contradicts you ignore the warning sign.
Then there is recency bias, believing that whatever the market is doing today, it will do forever.
This is exactly how bubbles form. Think about a new investor during a booming bull market. They assume stocks only go up. They see their neighbors making rapid profits, so they enter the market late using leverage.
And their confirmation bias makes them ignore the absurd valuations. When the bubble bursts, that leverage accelerates the downside, resulting in destruction.
It is a vicious cycle. We also have to talk about the endowment effect.
Oh, where people overvalue an asset just because they...
Yes, people will hold on to a fundamentally broken company for years, refusing to sell it, because accepting the loss feels like a personal...
Which ties right into loss aversion, feeling the pain of a loss twice as intensely as the joy of a gain.
Right. Prospect theory. That asymmetry makes investors irrationally conservative after a crash, preventing them from buying distressed assets when the expected returns are mathematically at their highest.
We also see overconfidence, thinking you can outsmart, and home bias, only investing in your own country's companies because it feels familiar.
It blinds you to massive global growth. So, since we cannot surgically alter our neurobiology, what is the practical antidote to...
We have to implement structural guardrail, and the ultimate tool for that is annual rebalancing.
Yes, rebalance, mechanical, automated...
Can you walk us through how that forces an investor to do the right thing?
Sure. Suppose your target allocation is 60% global equities and 40% treasuries. Over a 2-year period, equities have a massive bull run. Treasuries stay flat.
So your portfolio drifts. Now you are at 70% equities and 30%. You are carrying more risk. To rebalance, you execute a mechanical adjustment. You sell the equities that went up and use the proceeds to buy the treasuries that lagged, restoring the 60. But behaviorally, that is so hard to do. Your brain is screaming to hold the winning asset.
Exactly. That is why it has to be automated. Rebalancing forces you to systematically sell high and buy low without relying on emotion. It puts your rational decision-making on autopilot. Chapter 7. Emotional Resilience and the Purpose of Wealth.
Financial success without emotional fulfillment is ultimately, by managing focus and expectations, investors' true wealth, which is characterized by joy.
As we finalize this framework, we have to bring the conversation to its ultimate philosophical conclusion. What is the point of accumulating all this money if the process makes you miserable?
That is deepest truth. Money simply magnifies who you already are. Success without fulfillment is the ultimate.
Right. If someone is naturally anxious and paranoid, adding $50 million to their bank account just makes them an anxious, paranoid person with a highly complex tax burden.
Exactly. Achieving massive financial success while living in emotional poverty is a tragedy. To achieve true wealth, we have to understand the cognitive triggers that cause human suffering.
There are 3 specific triggers.
The first is the fear of loss, constantly monitoring the news, terrified that a black swan event will evaporate your life's work.
The second is the fear of having less, the hedonic treadmill, always comparing yourself to your peers, so the goalpost constantly.
And the third is the fear of never having what, the despair that the math just compound fast enough to...
So how do we interrupt those destructive cognitive loops?
We utilize a physiological reset. It's called the 90.
The 90-second rule, how does that work?
When faced with a financial stressor, like a sudden market drop, your amygdala triggers the stressor. You feel the cortisol spike. The rule dictates that you give yourself exactly 90 seconds to fully experience that front.
Okay, acknowledge it for 90 seconds, and
then you forcefully intervene. You shift your focus away from the tension and consciously find something in your immediate reality to appreciate.
Like a neurological override.
Exactly. The dopamine and serotonin pathways associated with deep gratitude physically inhibit the production of cortisol. You biologically cannot suffer and appreciate at the exact same time.
That is incredibly powerful. Let's contrast 2 different people to really illustrate this. Consider a highly successful retiree, millions in the bank.
Okay.
But they live in constant terror of losing it. They view every market fluctuation as a personal threat. They sacrifice their health and relationships to defend their portfolio.
They possess immense capital, but they are slaves to their own balance sheet.
Exactly. Now contrast them with an average income family who automated their savings early. They live within their means.
Because they trust the mathematical architecture, they don't even look at the daily financial news.
Right.
They allocate their energy toward their family and their community. They experience immense daily joy. They weaponize their capital to purchase the ultimate luxury, time, and that is true wealth.
So, Sonia, as a final reflection, what does it truly mean to be financially unshakable.
Being unshakable isn't about having infinite money. It is a state of mind. It is unwavering confidence of knowing that while the global economy is chaotic, you control your exposure, you control your assets, your fees, your reaction, and your happiness.
When you align structural preparation with emotional regulation, no economic win. What an incredibly dense and vital.
It really was. We covered everything from market corrections to avoiding fees, mastering psychology, and finding actual.
It has been a privilege to dissect these mechanisms. Thank you for joining us on ZAM Audiobook. We will leave you with a final challenge.
Yes, a challenge for everyone listening. The next time you open your financial statements, observe your immediate biological response. Don't just look at the numbers. Ask yourself, am I controlling my money or is my money controlling me? Have a wonderful day.